Let me start with a question. What if Bitcoin is not failing, not broken, not manipulated, not suppressed, but instead reacting rationally to a risk most people are barely aware of? Because when you zoom out and look at the broader financial landscape, something doesn't add up. Gold has doubled. Silver has gone even further. Commodities across the board have rallied hard. The US dollar is sitting near a 4-year low. Confidence in institutions is fragile. Debt levels are extreme. Geopolitical tensions are rising, and trust in fiat money is clearly eroding. This is exactly the environment Bitcoin was designed for. And yet, Bitcoin is not exploding higher. It's not collapsing either. It's just stuck. Sideways, hesitant, underperforming expectations. And markets usually don't behave this way without a reason. Today, I want to walk you through a possibility that almost nobody talks about in depth. A possibility that institutional investors are quietly starting to factor in. And a possibility that could fundamentally change how we think about Bitcoin's long-term risk. This is not a clickbait, Bitcoin is dead video. It's the opposite. It's a video about why Bitcoin's biggest risk is not price volatility, regulation, or competition, but something far more subtle, something mathematical, something structural, quantum computing. Now before you click away, stay with me, because this topic is often misunderstood, oversimplified, or dismissed entirely. And once you understand it properly, you'll never look at Bitcoin security the same way again. To understand the problem, we first need to understand what Bitcoin actually is. Bitcoin is not just money. Bitcoin is not just software. Bitcoin is not just a network. Bitcoin is at its core a cryptographic system built on very specific assumptions about what computers can and cannot do. For over a decade, those assumptions have held up beautifully, but that doesn't mean they hold forever. Bitcoin relies on cryptography to answer one very simple question: who owns what? When you send Bitcoin, the network doesn't know who you are. It doesn't know your name, your identity, or your location. All it knows is that a transaction is accompanied by a valid cryptographic signature. If the signature is valid, the transaction is accepted. And this is where trust comes from. The entire Bitcoin system assumes that only the true owner of a private key can produce a valid signature. If that assumption holds, Bitcoin works. If it fails, Bitcoin doesn't just lose value, it loses meaning. So how does this actually work? Bitcoin uses two different cryptographic mechanisms, and they serve very different purposes. The first is hashing, specifically SHA-256. This is used in mining and block creation. Miners compete to solve cryptographic puzzles, and the difficulty adjusts automatically. Even if computing power increases, the system adapts. Quantum computers don't break this. At worst, they give a limited speed advantage, and the network adjusts. The second mechanism is digital signatures, specifically ECDSA, the elliptic curve digital signature algorithm. This is the one that matters. ECDSA is what allows you to prove ownership of Bitcoin. It's the lock on the door. Right now, with classical computers, it is computationally infeasible to derive a private key from a public key. You could try for billions of years and get nowhere. This is why you can safely share your Bitcoin address with the world. But quantum computers play by different rules. A sufficiently powerful quantum computer running Shor's algorithm could reverse that relationship. It could take a public key and mathematically derive the private key behind it. Not by guessing, not by brute force, but by solving the underlying problem directly. This isn't speculation. It's not controversial in cryptography. It's well-known, well-studied, and widely accepted. The only real question is timing. Now here's where things get interesting, and where most discussions completely miss the point. Quantum computers do not automatically break all Bitcoin. They don't magically crack wallets at random. They need one thing first. They need your public key. And not all Bitcoin addresses expose public keys in the same way. In the early days of Bitcoin, addresses were essentially raw public keys. When someone received Bitcoin, their public key was immediately visible on the blockchain. Anyone could see it, forever. Those coins are permanently exposed. Over time, Bitcoin evolved. Modern addresses are not public keys themselves. They are hashes of public keys. Think of it like a P.O. box instead of a home address. You can send Bitcoin to the box, but nobody knows where the house is. The public key only appears when you spend from that address. Until that moment, it remains hidden. This means something very important. Quantum computers cannot attack what they cannot see. If your public key is not visible, they don't know which lock to try to pick. But once your public key appears on-chain, the situation changes. From that moment on, your security depends on one thing: how long it takes an attacker to derive your private key versus how long it takes the network to confirm your transaction. Bitcoin's average block time is about 10 minutes. If a quantum computer can derive a private key in days or weeks, the damage is limited to already exposed addresses. If it can do it in minutes, the entire system breaks, because the moment you broadcast the transaction, your public key is revealed. An attacker could generate a competing transaction, sign it with your derived private key, and get it mined before yours confirms. At that point, it doesn't matter how careful you were. Now let's talk numbers. As of today, a surprisingly large portion of Bitcoin's total supply sits in addresses where public keys are already exposed. These include early Bitcoin addresses, reused addresses, and certain modern address types that intentionally trade some security for efficiency or privacy benefits. Rough estimates suggest roughly 1/3 of all Bitcoin is in this category. Those coins are not just theoretically vulnerable, they are structurally vulnerable. And this is where the systemic risk appears, because Bitcoin's value is not determined by whether your coins are safe. It's determined by whether the network is trusted. If attackers start draining exposed wallets, confidence collapses long before protected wallets are touched. Markets don't wait for fairness. This is why institutions care. Large investors don't need a risk to be imminent. They need it to be plausible and unhedgeable. Over the past couple of years, some institutional players have quietly started to acknowledge this. Risk disclosures have been updated. Internal models have changed. Some portfolio allocations have been reduced or removed altogether. Even major ETF issuers like BlackRock have explicitly warned that any fundamental cryptographic changes to Bitcoin would require broad consensus, and that there is no guarantee such changes could be implemented in time. This matters more than people realize. Banks, governments, and intelligence agencies also rely on cryptography, but they are centralized. If an algorithm becomes obsolete, they can rotate keys, change standards, and force upgrades internally. Bitcoin cannot do that. Bitcoin is decentralized. Every meaningful upgrade requires agreement across developers, miners, node operators, exchanges, custodians, and users. Even when there is consensus, rollout takes years, and not everyone participates. Some wallets are abandoned, some keys are lost, some holders are inactive, some coins will never move. This makes migration to quantum-resistant cryptography one of the most complex coordination problems Bitcoin has ever faced. It's not impossible, but it's not easy, fast, or guaranteed. Now let's address the obvious question. How close are we, really? Today's quantum computers are nowhere near powerful enough to break Bitcoin. The most advanced machines operate with a few hundred noisy qubits. Estimates suggest millions of error-corrected qubits would be needed to crack a Bitcoin key in a reasonable time frame. That sounds far away, but technological progress is rarely smooth or predictable. Breakthroughs happen, new error correction methods emerge, algorithms improve, AI accelerates research. What looks decades away can suddenly look much closer. Markets don't wait for confirmation. They price risk when uncertainty becomes asymmetric. Gold doesn't face this problem. Its security model hasn't changed in thousands of years. It doesn't rely on cryptographic assumptions or software upgrades. Bitcoin does. That doesn't make Bitcoin bad. It makes Bitcoin different. It means Bitcoin carries a unique form of technological tail risk that most investors are not used to thinking about. So what does all this mean? It doesn't mean Bitcoin is doomed. It doesn't mean panic selling. It doesn't mean abandoning the asset entirely. It means understanding Bitcoin for what it truly is, a revolutionary system built on brilliant cryptography whose long-term success depends on staying ahead of technological progress. Ignoring that reality is not optimism, it's complacency. Bitcoin has upgraded before, it can upgrade again. But quantum risk is not something you solve at the last minute. Mathematics doesn't care about belief, narratives, or conviction. And that is why Bitcoin's quiet problem matters now, not when it's already loud.